Do you have questions about your mortgage payment and the timing of your purchase in general? Because it enables you to stabilize one of your biggest costs and one of your most fundamental requirements, real estate is an excellent long-term investment for everyone. However, many mortgage for first-time buyer are concerned about overspending or purchasing at the wrong moment. Everybody's financial situation is unique, so every individual's purchase choice will be different. As a result, what may be a good time for one person may not be a good time for another. We'll cover some of the key information you need to know about what your mortgage payment should be and when it is a good time to purchase. Hello everyone, welcome to Finance Wisdom. In this video, we're going to talk about things that can help your mortgage for first-time buyer. If you're new to this channel, do like and subscribe to the channel. When discussing assets, especially real estate, professionals in the financial sector often make reference to time in the market. That is unquestionably the situation. You should be okay if you wish to buy a house and live in it for at least 5, 7, or 10 years after you make the purchase. The history of real estate has almost always been favorable. If you buy a house now and take good care of it, it's always in 10 or 20 years should be more than what you paid for it. Taking into account the market as a whole in the United States, there is a possibility that it may go down in value some years. Make sure you're not spending too much of your salary on housing for your personal budget. According to the standard rule of thumb, you shouldn't spend more on housing than 28% of your gross income. I'm referring to the overall mortgage payment when I discuss mortgage payments. Principal interest, taxes, insurance and mortgage insurance are the topics I'm referring to. I also bring up mortgage insurance if you must pay it. Most financial experts would advise you not to spend more than 28% of your salary on housing due to any homeowners association fees, the overall cost of your paying for that property on a monthly basis, and other factors. How much money do I bring home each week and how much of it should I put toward housing? I prefer to use the range of 25 to 35%. Now, 25% is a Dave Ramsey guideline, and when he mentions it, he means 25% on a 15-year mortgage, meaning you'll pay off the mortgage in 15 years and are only devoting 25% of your take-home income to debt. Since the 28% refers to your gross salary before any deductions, I'm going to suggest 25 to 35% of your take-home pay instead, since I believe that's a touch too conservative for the majority of Americans. However, I think you'll be good if you're between 25 and 35% of your take-home pay. If you owe money to many parties, you may want to exercise particular caution. If the industry in which you operate is not known for its dependability, you may need to exercise even more caution. If the industry in which you operate is not known for its dependability, you may need to exercise even more caution. You do not want to find yourself in a position where you cannot afford other essentials due to your lack of income from working outside the house. To put food on the table, pay for childcare, maintain insurance coverage, and cover the myriad of other expenses that come along with living requires paying for all of these things. You don't want to put so much money into your house that there's nothing left over for other things, especially investments. You want to have the capacity to make investments in the future, because it is often necessary to live paycheck to paycheck and pay all of our expenses, leaving us with no spare income. You should have some money put aside so that you may invest in opportunities for the future. Consequently, if you had the opportunity to put money into a business enterprise that would allow you to acquire an investment property, would you do so? If you are so financially strapped and settled with debt that the whole of your income goes toward paying off your obligators, you will not be able to take advantage of any more opportunities when it comes to purchasing a property. You need to practice extreme frugality since anything you make gets spent. Your household budget will provide you flexibility, which will allow you to carry out the other activities that are important to you in life. If you like this video, don't forget to like and subscribe to the channel. Let's continue to discuss mortgage for first-time buyer. Let's go through an example of how to use all of these numbers together. Let's apply the basic rule of thumb to someone earning $6,000 per month or $72,000 per year. that person's gross salary would be $1,680 or 28% of it. It is recommended that they contribute no more than that amount to their mortgage payment in full. In my case, the range was 25 to 35%, and let's suppose that they make $4,500 out of $6,000 after taxes. Assuming a 25% tax rate, they would not spend more than $1,375. This isn't going to be precise, but maybe close to these figures on their mortgage. And in the Dave Ramsey example of a 25% tax rate, they would not spend more than $1,125. Many of you may find this shocking and think that no one could possibly afford it. But remember that finances are highly personal and that if you spend too much of your salary on housing, you won't have enough money for the other things you want to do. If you want to spend a little bit more on housing and you don't have any other debt, you may have a very high monthly income. However, before making that decision, you should consult a financial planner to see if you're financially prepared to accomplish the rest of your financial objectives and to know the mortgage for first-time buyer. You want to make sure that your finances aren't fundamentally too stretched. So they'll look at your debt, insurance, investments, and all of those things and say, okay, you can push a little higher because you have everything else in place or you have enough money coming into your 401k, Roth IRA, and other areas that you can do more than that. But you want to think about that very carefully rather than just saying that. I'll finish with another essential point. When individuals are believed to be broke, they spend first, like they spend, and then they save and invest what's left, which is nothing. Wealthy individuals think differently. If you're set up such that you are maxed out and your investments are, you will have money on the side for possibilities you may have. People will go ahead and save and invest first, and then they will spend what is left over. You know, after all of your basic needs are taken care of, you say, okay, I have 20% or 25% for housing. And you get creative by asking, okay, where can I live where I'm safe? Where can I live where I have maybe a good school system? Or whatever your preferences are, where I can live on that budget that's going to work for me. We've reached the end of another video and thank you for watching. I hope you have learned how to mortgage for first-time buyers. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.